Hi, welcome to this revision video on financial markets, instruments, and assets pricing. The goal of this video is simple to help you quickly revise the main ideas of Unit 4 so that concepts like financial markets, their functions, different segments, and later topics like valuation and asset pricing feel familiar and easy when you see them in your notes or question papers. Now, think of this video as a concept refresher. We are not going to do any heavy derivations here, but we are making sure that the story of financial markets is crystal clear in your mind. So, Unit 4 in your course is titled Introduction to Financial Markets, Instruments, and Asset Pricing. Sits inside the broader paper of Money, Banking, and Finance. In your earlier units, you have seen money, banking, and monetary policy from a macroeconomic or institutional perspective. In this unit, we zoom in on financial markets themselves, how they work, what instruments are traded, and how we put value on those instruments using idea like time value of money, bond pricing, portfolio theory, and basic corporate finance. So this unit links macro concepts with finance concepts. It connects savings and investment with actual mechanisms that move funds around the economy. Before we go deep into the first conceptual topic, let me very briefly revise what this unit covers overall. The main themes are role and functions of financial markets, the types of financial instruments, that is debt, equity, derivatives, and foreign exchange related instruments. Then we have uh, time value of money and discounting. That is the idea that money today is more valuable than the money in future. Then we have bond pricing, yields and duration, where we see value how we value fixed income securities and measure their interest rate risk. Then we have portfolio theory and efficient frontier. How this shows how combining assets can reduce risk and improve risk returns trade-off. Then we have stock markets and its derivatives. That is how equity and derivative markets operate and what roles they play. And lastly, we will have the basics of corporate finance. That is how firms make investment, financing, and dividend decisions with objective of maximizing shareholder wealth. So in this particular revision video, we mainly focus on the first theme, the role and uh, functions of financial markets and their main segment. Once that base is clear, then the later topics becomes much easier to digest. First, let us answer a very basic question in everyday language. What is financial market? Now, imagine household, farms, and government, some of them at any point in time have extra money that they are not using immediately. These are surplus units or also known as savers. Others need money to finance their activities. A business wants to expand capacity, a government wants to build highway, or a student wants an education loan. These are deficit units and also known as borrowers. Now, if we do not have a financial system, the only way to connect these two groups would be direct informal lending. That is, one person physically finds another person and lends the money. That is very slow, risky, and not scalable. So, a financial market is essentially the organized mechanism that is formal, regulated, and often technology driven that connects people who have surplus funds with those who need funds, usually through financial instruments like bonds, shares, and deposits. So you can think of it as a big meeting place, not always physical, where savings are converted into investments through buying and selling of financial claims. Now we come up to the very fast and fundamental role, that is financial markets channel funds from surplus units to savers, that is the savers to the deficient units, that is the to the borrowers. Now, households typically earn more than they spend at some point in their life cycle and they save the difference. If the savings lie idle as cash, they do not generate much benefit for the economy. Through financial markets, these savings are mobilized. Households deposits money in bank, buy mutual funds, purchase government securities, or buy shares, and these funds then reach businesses and the government as loans, bonds, or equity capital. This is what we know as capital allocation. So financial markets direct savings into productive investment projects like factories, infrastructure, technology, rather than letting them sit idle. By doing this, they support economic growth, employment, as well as development of the economy. Now let us come to the second major function, that is liquidity provision. Liquidity means how quickly and easily you can convert an asset into cash without losing much value. Cash in your wallet is perfectly liquid. A piece of land is illiquid. Why? We may take months to find a buyer and may have to compromise on the price. So financial markets make many financial instruments like shares and bonds which are reasonably liquid. If you hold share in a listed company and you suddenly need money, you don't have to beg to the company to buy back your shares. You can simply sell them in the stock market to another investor at prevailing market price. That the ability to buy and sell quickly at a relatively low transaction cost is what we mean by liquidity. That is the ability and to buy and sell quickly at a very low transaction cost. Now, so financial markets give investors the confidence that they can exit their position when they need cash, which encourages them to invest in the very first place. Now let us come to the third key function, which is known as price discovery. Every financial asset, a share, a bond, a currency, has some underlying value based on the cash future flows. It promises and risks around the cash flows. But no single individual knows the correct exact value. And different investors have different information, expectation, and risk appetites. So in a financial markets, these diverse views meet together. Some people may think that the asset is undervalued and want to buy. Other may think that it is overvalued and want to sell. But no single individual knows the correct information. So through continuous interaction of demand and supply, that is through bids and offers, the market discovers a price at which the trades actually take place. So the market price is not perfect, but is a powerful signal. It tells us, on average, informed investors currently believe about the value and risk of that asset. This process of arriving at that price through market forces is basically price discovery, and it guides how resources are allocated across different firms and across different sectors. Now let us come to the fourth important function or role, that is risk management. In So financial market help with risk management. In real life, there is uncertainty everywhere. Interest rates can change, exchange rates can move, stock prices can fall, and borrowers can default. So if each economic agent had to bear all this risk alone, many investment would not simply happen. So financial markets provide instruments that allow people to share, transfer, or basically hedge the risk. For example, a company that will receive dollars in future can use the foreign exchange market to lock in today's exchange rate and protect itself from currency risk. Investors who are afraid that stock might fall can buy a put option as insurance. Banks diversify their lending across many borrowers to reduce the impact of any single default. So, through bonds, through insurance contracts, through derivatives and diversification, the financial system redistributes the risk in a way that makes risky but productive projects more acceptable. Now, let us come to the last or final fifth role, that is information aggregation. Financial markets perform the function of information aggregation. Information about companies and the economy is scattered among many people, managers, employees, investors, analysts, the media, and so on. So, no single person has all the information, and much of it is subjective. Expectation about future profits, interest rates, and policies and technologies. So, all those things are subjective in nature. So, when thousands of investors analyze this information and make buy or sell decisions in the market, their actions collectively push prices up and down. The resulting market prices incorporates or aggregates a huge amount of dispersed information into one place. This is why an unexpected negative news item can suddenly fall cause a fall in share prices while new information is being absorbed into the prices. So whenever you get some good information, their share prices may increase. But a negative information can cause a sudden fall in the share prices. So because of this, policymakers and investors look at asset prices like bond yields, stock indices as indicators of market sentiments and expectation. So now let us come to the major segments of financial market. Now we understand what financial markets do. So now what major segments we should remember. So usually we divide the financial market into these four major segments. The number one is money market. The money market deals with short-term funds and instruments, typically with maturities of less than 1 year, such as treasury bills, commercial paper, and certificates of deposit. It is mainly used by banks, corporations, and government for short-term liquidity management. The second is capital market. Capital market deals with long-term securities like shares and bonds, where businesses and governments raise funds for long-term investment projects. Stock exchanges like National Stock Exchange or Bombay Stock Exchange are part of capital market for equity. Long-term government and corporate bonds are also traded in this particular exchanges. Then we come to the forex market, which is also known as foreign exchange market, where currencies are bought and sold. Rupees against dollars, euro, yen, or so on. It is essential for international trade and cross-border capital flows. And the last, we have derivative markets. Derivative markets deal with instruments like futures, options, forwards, and swaps, whose value is derived from the price of an underlying asset such as stock index, commodity, or currency. So these are used for hedging risk, speculation, or arbitrage. Together, these segments form an interconnected network through which savings moves to investment. Risks are managed and prices are discovered. Now let us understand what do we mean by financial instruments and what are the main categories you must remember for the exam. Now a financial instrument is a simply a monetary contract representing what? Representing a claim. So it is simply a monetary contract that gives the holder a claim on future cash flows. These cash flows can be interests, dividends, or capital gains when the price of the instruments goes up. So think of it in this way. When you hold a financial instrument, you are holding a piece of paper or an entry in a demat account that entitles you to receive money in the future under certain conditions. So we usually classify financial instruments into the four broad categories that you can see on the screen. That is debt instruments, equity instruments, derivative instruments, and foreign exchange instruments. Now let us go through them one by one. Number one is debt instrument. A debt instrument represents loan. One party has borrowed money and the another party has lent money. The borrower promises to pay back the principal and also pay the interest rate according to a fixed schedule. Common examples of these debt instruments include bonds, debentures, bank loans, treasury bills, government securities. So if you buy a bond, you are effectively lending money to the issuer, which could be a company or the government, and in return, you are entitled to periodic interest payments and the repayment of the face value at maturity. So, debt is usually considered a low risk asset or instrument compared to the equity because the payments are contractual and debt holder are paid before the equity holders. But the return is also limited to the agreed interest plus the principal amount. Now, second, let us move on to the equity instruments. Equity instruments generally represent ownership in a company. When you buy shares, you become a part owner. So typically, instruments are ordinary, that is equity shares, and preference shares that trade on the stock exchange like National Stock Exchange or Bombay Stock Exchange. So an equity holder, as an equity holder, you have a residual claim on the company's profit after paying the interest to the debt holders and meeting other obligations. Whatever profit is left can be redistributed to the shareholders as their dividends or retained in their businesses. So equity is riskier than debt because dividends are not guaranteed and the share price can fluctuate widely. But it also offers higher potential upside if company performs well and grows over time. Now let us move on to the third financial instrument, that is the derivative instruments. The word derivative itself tell you the main idea that the value of derivative is derived from an underlying asset such as stock, uh, uh, an index like Nifty, a commodity, or a currency. So common examples are futures, options, forwards, and swaps. So these instruments are often used to hedge risk. For example, to protect against changes in prices or exchange rate, or to speculate and take leveraged positions based on expectations of the future price movement. Now, the last instrument that we see is forex or foreign exchange instruments. So these instruments are related to the name itself, that is foreign exchange, such as the holdings on foreign currency, banks deposit denominated in foreign currency and foreign exchange contracts. So they are used heavily in day-to-day international transactions such as import and export payments, foreign investments and remittances, where parties need to convert uh, one currency into another. So quickly to summarize, so debt is about borrowing and lending with fixed claims. Equity is about ownership with residual claims and higher risk. Derivatives are contracts whose value depends on some underlying assets, and foreign exchange instruments are all about currency related positions and contracts. Now we move on to the one of the most fundamental ideas in finance, the time value of money. The time value of money says that unit of money today is worth more than the same unit in future. Why is this true? Because money today can be invested to earn a return. Because inflation reduces the purchasing power of money over time. And because there is always a risk or uncertainty about what a future payment will actually be received or not. Now, in this topic, we focus on two basic operations, that is compounding and discounting. Compounding means taking a present sum of money and moving it forward in time by applying an interest rate. For example, if you deposit, say, 1,000 rupees in a bank at a 10% annual interest rate, so after 1 year you will have 1,100 rupees, and after more years you earn interest on interest, that is compounding. Now, discounting is the opposite. It means taking a future sum of money and bringing it to today's value using a discount rate. Say someone promises you to pay 1,100 rupees 1 year from now, and the appropriate interest rate is 10%. So the present value of the future payment is 1,100 divided by the 1.10, that is 100% plus 10%, which is 1,000. That tells you that receiving 1,100 next year is equivalent in value to receiving 1,000 today, given a 10% interest rate. So we write the present value of a single future cash flow as this uh, given formula that you can see on the screen. Uh, which is written as PV equal to CF1 by 1 plus R, where CF1 simply shows the cash flow one period from now, and R is the discount rate or the interest rate. Now, if there is a stream of cash flow over several periods, say from uh, uh, T, which is time 1 to time capital T, this present value is given by this formula, which you can see is a summation of CF T by 1 plus R whole to the power T. So where you discount each cash flow back to today and then add them all up. So this formula allows us to compare different investment opportunities because uh, we can express all future cash flows in terms of today's value and then see which one has higher present value. So the time value of money and discounting are the backbone of valuation, all valuation in backbone of all valuation in finance. Whether you are valuing bonds, shares through dividends, or investment projects in finance. So these formulas give us the idea what is the valuation of the finance Now let us move on to the next topic. Now we will see how we use time value of money to evaluate investment projects using net present value and internal rate of return. So imagine a company is considering a project and has to invest some amount which is denoted by say I0 today, and in return it expects to receive a series of cash inflows over the next few years. So how do we decide whether the project is financially worthwhile? Net present value or NVP gives a clear answer. We discount all expected future cash flows back to the present using an appropriate discount rate, R, often the cost of the capital, and then subtract the initial investment. That is why you will find a minus sign uh, in front of the initial investment. Now, mathematically, this is given as this particular formula NVP equal to minus the initial investment plus the present value of the project. Now, if NBP is greater than zero, the the project is adding value to the farm. That means the project return is more than the required rate of return. So we will accept the project. If NBP is less than zero, then the project is destroying value. So we will reject that particular project. Now, if we have several mutually exclusive projects, that is, we cannot take all of them. We have to choose the one which gives us the highest positive net present value, that is NVP, assuming the projects are comparable. Now, NVP is widely considered the preferred or gold standard method in modern corporate finance. So whenever we will be studying modern corporate finance, or in future if you go through any studies relating to finance, you will find that NBP is the one key tool which is used to study the value of product projects. So because it properly uses the time value of money and allows us to incorporate the risk through an appropriate discount rate. Now let us come to the internal rate of return, IRR. In internal rate of return is closely related to the related concept but is defined in a very different way. Internal rate of return is the discount rate that makes the NBP of the project exactly zero. In other words, this whenever we will solve this particular equation, the value of R that we are getting, that is the internal rate of return. So you think of IRR as the project's own internal rate of return. It is the rate at which the present value of inflows is exactly equal to the initial outflow. So the decision rule for IRR is that accept the project if IRR is greater than the cost of capital. That is the minimum return required by the investors. And reject if the IRR is less than the cost of capital. In simple language, if the project's internal return beats what investors are demanding, it is a good project. If it does not, the project is not attractive. In practice, MVP and IRR usually give the same accept reject decision for a single project. But when we are comparing multiple projects or dealing with unusual cash flow patterns, net present value is more reliable and is generally preferred. Other criteria that you may see in the text textbooks are the payback period and the accounting rate of return. The payback period simply measures how many years it takes to recover the initial investment from the project cash flow, and it ignores the time value of money and cash flows beyond the uh, payback cut. The accounting rate of return is a similar concept which uses accounting profits rather than cash flows, and it also does not fully incorporate the time value of money. So this is why in modern finance, NVP and IRR, both based on discounted cash flows, are considered more rigorous, and at present NVP is treated as the primary criterion. Now let us try to understand fixed income securities, especially bonds. A bond is usually a long-term IOU. When you buy a bond, you are lending money to the issuer. This could be government or a company, and in return, the issuer promises two things. First, to pay you a periodic interest called coupons, and second, to pay back the face value, also called as par value at maturity. To find the fair price of a bond today, we use time value of money. We treat the bond as a package of future cash flows, a stream of coupon payments, plus one large payment of face value at maturity. The pricing formula says that the price of the bond P is equal to the present value of all coupons plus the face present value of the face value. In symbols, you can see it is written as this particular formula. It is given by this thing. Now, where you can see C is the annual coupon, F is the face value, Y is the yield to maturity, and T is the maturity period. So, maturity period can run from 1 year to the time till maturity. Now, in simple words, we discount every future payments back to today using a discount rate uh, Y, that is the bond's yield, and then add them up. The total gives us the bond's theoretical fair price that we get as P. Now, an extremely important relationship you must remember is the inverse relationship between bond prices and the market interest rate. When market interest rate goes up, bond prices goes down. And when interest rate goes down, the prices of the bonds goes up. Now, why does this particular thing happen? Imagine you hold a bond paying a fixed coupon, say 8%. If new bonds are suddenly being issued at 10%, your 8% bond becomes less attractive. To compensate, the price of the bond in the market must fall so that a new buyer effectively earns a yield closer to the new market rate. So, bond prices and market yields move in opposite direction. So they operate in opposite direction. This is central to understand the interest rate risk. Now, let us come to yield to maturity. Actually is yield to maturity? YTM or yield to maturity is a single discount rate that makes the present value of all future coupons and the face value exactly equal to the current market price of the bond. If the say if the bond price is below the face value, a discount bond, its yield to maturity will be higher than its coupon rate. You are getting extra return because you are buying the bond cheap and still receiving the full value at maturity. If the bond price is above the face value, a premium bond, its YTM, that is yield to maturity, will be lower than its coupon rate because you are paying more now for the same fixed payments. Now let us talk about the duration and convexity. Duration or modified duration is a measure of a bond's sensitivity to changes in the interest rate. Uh, Roughly speaking, it tells the percentage change in the bond's price for 1 percentage point change in the yield, whatever we will be getting in future. Now, long-term bonds and low coupon bonds tend to have higher duration, which means their prices respond more strongly to interest rate change. Slow term or high coupon bonds have low duration and are less time sensitive. Now, convexity goes one step further. It captures the relationship between bonds and yields. The price yield curve is not a straight line, it bends. Duration gives us the approximation for small changes in the yields, but for larger change, the convexity improves the approximation by accounting for the curvature, which we will see. Now, things to remember is that you remember, try to remember the bond pricing formula from this. You try to explain the inverse relationship between price and yield or price and interest rate. Also try to define yield to maturity in your own words. Okay. Now let us move on to the next part. Now we will see what is portfolio theory and what is efficient frontier. These are about how investors can manage risk and return by combining different assets. In reality, most investors do not put all their money in a single share or a single bond. They hold a portfolio that is a collection of assets. The key idea is that the behavior of the portfolio depends not only on the individual assets but also how the assets move together. The first, the return of asset over a single period is given by R equal to P1, which is the price at the end period, minus P0, which is the initial price, plus D, which is any dividend received by the divided by initial price. Now, it is basically gain divided by initial price. For a portfolio return, the return RP is weighted average of the returns on individual assets. So it is given as summation of WI by RI. So WI is the proportion of your total wealth invested in asset I, and RI is the return on asset I. Similarly, the expected uh, portfolio return is it is the just weighted average of expected return of each assets. Whatever we are saying, whatever expected we are, it is simply weighted average of expected return of each assets. Now, the most subtle part is the risk. We measure as variance or standard deviation of the returns. So the portfolio variance is given by this particular formula that you are seeing, this particular formula. Now, this formula looks very heavy, but the intuition is simple. If two assets moves very differently, say when one goes up, the other often goes down, then the holding both together can reduce the overall volatility of your portfolio. The key insight of diversification is that when assets are perfectly positively correlated, not perfectly positively correlated, uh, that is, correlation is less than 1, then the risk of combined portfolio can be lower than the weighted average risk of individual asset. This is the benefit of not putting all your eggs in one basket. So basically, we are diversifying our portfolio. Now let us move on to the efficient frontier, or also known as Markowitz's modern portfolio theory. It says that for a given set of risky assets, we can find many possible combination portfolios, and each with its own expected return and risk. So let us see if we plot what we will get. Now, this particular frontier that we are seeing, it is the efficient frontier. Now, if we plot the rate of return on the vertical axis or standard deviation, that is, we can see on this, and whatever we are drawing, this gives us the efficient frontier. So efficient this frontier for each level of risk, the portfolio that has lowest possible variance shows the portfolio that has lowest possible variance. Now, among these, the upper part of the curvature, where for each level of risk you get the maximum possible expected return we are getting. You get the maximum expected possible return. So that is why it is known as the efficient frontier. So in simple language, efficient frontier represents a set of optimal portfolios that provide the highest expected return for a specific level of risk, or the lowest risk for a specified level of expected return. So portfolios located on this efficient frontier are regarded as the most efficient because they offer the optimal trade-off between risk and return. So modern portfolio theory seeks to identify the optimal portfolios that we can see on the line on the efficient frontier that corresponds to the investor's specific risk tolerance and financial objectives. Okay, now let us visit stock markets and derivatives, which connects the theory which we have learned to the actual market institutions. The stock market or equity market is where ownership of share companies are issued and traded. It has two main part, primary market and the secondary market. In the primary market, new securities are issued for the first time. When a company wants to raise a long-term equity capital, it can do an initial public offering, which we know as IPO, where it sells shares to the public, or a rights issue, where new shares are offered to the existing shareholders. In the primary market, the company actually receives funds from investors. In the secondary market, existing securities are traded among investors on the stock exchanges such as National Stock Exchange and the Bombay Stock Exchange. Here, investors buy and sell shares from each other. The company does not get new money, but shareholders get liquidity. Stock indices like Nifty 50, Sensex are constructed from a basket of selected shares. They summarize the overall market movements and serves as a benchmark against which portfolio performance is compared. Now, the stock market plays crucial roles in the economy. It helps in uh, capital formulation by channeling savings into productive investments. It promotes corporate governance. because managers know that poor performance will be punished by the market. It provides liquidity, allowing investors to enter and exit positions easily. It also improves transparency as prices incorporate publicly available information. Now, let us go through derivatives market. Now, derivatives are financial instruments whose value is derived from an underlying asset, such as stock, index, commodity, or currency. The common derivatives we know are futures, options, and forwards and swaps. Now, a future is a contract which is standardized agreement traded on an exchange to buy or sell an underlying asset at a specified price on a future date. Both parties are obligated to fulfill the contract, and the exchange's clearing houses reduces the counterparty risk. Now let us come to option. An option gives the buyer the right, but not the obligation, to buy or sell the underlying asset at a pre-specified price, that is also known as strike price, on or before a certain date, in return for paying a certain premium. A call option is the right to buy, and a put option is the right to sell. So there are two types of option. One is call option, which gives us the right to buy, and one is put option, which gives us the right to sell. Now let us come to forwards and swaps. Forwards and swaps are usually over-the-counter contracts negotiated directly between the parties. They are used primarily by institutions to hedge interest risk or currency risks. So basically, these three derivatives, futures, options, or forwards and swaps, are used for three main purposes. Number one is hedging, number two is speculation, and number three is arbitrage. Hedging reduces or is basically reducing or eliminating the risk of adverse price movement. Similarly, speculation is taking position to the profit from expected price movement, often using some leverage. And arbitrage is simply exploiting small price difference between related market or instruments to earn risk-free profit. In India, exchange traded derivatives on National Stock Exchange are regulated by SEBI, which sets the rule for transparency, margin requirements, and risk management to maintain the market stability. Now, see, you should be very carefully defining what is primary market and secondary market. Also, try to explain the roles of stock and the indices and clearly distinguish between futures, options, and forward swaps and what are their main uses. So this might come in examination. That is, what is difference between primary market and secondary market, and what are the distinguishing features between futures, options, and forwards and swaps. Try to go through that very carefully. Now let us go to the basics. Finally, let us go to the basics of corporate finance, which will tie together all the concepts, many concepts from these particular units. Now, corporate finance is about how firms raise fund, how they invest those funds in uh, assets, and how they raise funds, how they invest in particular assets, and how they distribute these particular returns back to the providers of capital. The central objective in standard theory is to maximize the shareholder wealth. Now, there are three core decisions in corporate finance: the investment decision, the financing decision, and the dividend decision, also known as dividend policy. Now, investment decision, also known as capital budgeting. This is where the firms decide which project to invest in, uh, that is new factories, new product lines, acquisition, etc. These projects are evaluated using the tools that we have learned, such as NVP, IRR, or discounted cash flow analysis. Only projects that create value, that is, have positive NVP, should be accepted because they increase shareholder wealth. The second is the financing decision, also known as capital structure decision. Here, the firm decides the mix of debt and equity it will use to finance its operation and investments. Debt has advantages such as tax benefit because interest is tax deductible, but it also increases financial risk and also can lead to distress if the firm cannot meet its obligation. Similarly, equity does not require fixed payments but may be more expensive in terms of required return. The firm aims to choose an appropriate debt and equity mix that balances the risk, return, and flexibility. And the third, that is dividend policy. This is about how much of the firm's earnings should be distributed as dividends to shareholders and how much should be retained with the firm for reinvestment. Paying high dividends, keeping investors happy in the short run, but leaves less internal finance for growth. Retaining more earnings supports future expansion, but may disappoint investors who want current income. So management has to strike a balance between current income and future growth. Now all these decisions are connected by the concept of cost of capital. So cost of capital is the required return required by the provider of funds, both debt and equity. It serves as the discount rate in project evaluation. When you were calculating NVP or IRR, this serves as a discount rate. If a project's internal rate of return is higher than the cost of capital, it adds value. If it is lower, it destroys value. Financial markets influence the cost of capital. Well-functioning, deep, and liquid markets make it cheaper for firms to raise funds, which encourages more investment and supports economic growth. Now, poorly functioning markets make capital more expensive and limit productive investment, which is harmful for economic growth. Now, let us close this particular unit. In this particular unit, we have seen how financial markets connects savers to investors, the different types of financial instruments, the time value of money and discounting, investment criteria like NVP and internal rate of return, bond pricing and interest rates, diversification, and the efficient frontier. We have also seen the functioning of stock and derivative market, and finally the core decisions in corporate finance. So before your exam, kindly revise, go through each and everything, and if you have any issues, you can simply ask me at any point of time. Thank you.